This past week, Elon Musk bought a significant stake in Twitter, and suddenly the whole world goes crazy with rumors of what he's up to, and the stock jumps a whopping 38% at one point as a result of the news. I'm Seth Freudberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the traders on our proprietary trading desk are acutely aware of the opportunities that a move like this can provide for options traders, and they're trained to formulate trades accordingly. In today's video, we're going to cover the details of a strategy you can use when a volatile move like Musk's buy-up of Twitter shares takes place. So if that sounds interesting to you, then stick around. I think you're going to find this pretty useful. Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so last week, Tesla's CEO Elon Musk made big news in the financial world when it came to light that he had spent over $2.2 billion in 2022 to become Twitter's largest shareholder. As a result, as you can see, the stock, which had been in a prolonged slump, gapped up over 30% on April 4th. And when that kind of move happens, 99% of the time, there's a spike in what options traders call the implied volatility of a stock, which is basically a way of measuring how volatile the stock's price is likely to become based on how the options market is pricing the options derived from that stock. And as you can see, the implied volatility of Tesla's options jumped from 54 to 79, which is a 45% increase in one day. And so to a professional options trader, this spells opportunity, as we'll see in a minute. Now, before we get into exactly how a professional trader can leverage implied volatility spikes like the one that happened last week with Twitter, I wanted to let you know that if you want to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. Okay, now the strategy that I'm going to be teaching today involves Twitter stock options, and I realize that most of you probably know something about how stock options work, but just for a quick review, and this is going to be quick, what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock has gone way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price. In other words, he's entitled to buy the shares way below market. He could flip them the next minute and make a huge profit on those shares in that case. Or conversely, for the put option, even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock's price has gone way below the strike price of the put, which effectively puts a floor on how much he can lose on owning that stock. Now, on the other hand, if at expiration you've sold a call and the market closes below the strike price of the call, then unless that call was previously exercised, the call just expires worthless and the call seller just pockets the premium. Similarly, if you've sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, it expires worthless and the call seller just pockets the premium. Okay, so keeping that in mind, let's move to the afternoon of April 4th in that elevated options volatility situation on Twitter. And let's say that on that day, we went ahead and pulled up the options chain expiring 4 days later on April 8th and simultaneously sold 100 of the 55 calls and bought 100 of the 60 calls, then moved down to the put side of that chain and sold the 100 of the 45 puts and bought 100 of the 40 puts. You'll notice that the short calls and the short puts are both almost exactly 5 points away from Twitter's price of $50.11 at that point in the afternoon, and that is no accident, as we'll see shortly. Now, why we did this will become more clear as we proceed, so just hang in there with me. Now, let's first take a look at the cash flow of having entered into this trade, which is called an iron condor. And as you can see, when you sold those 55 calls, you would have received a price of 81 cents. But remember, each options contract represents 100 shares of the stock, and so multiply that by 100, and you've sold 100 of them. And so you again multiply that by 100 for a total cash inflow from selling those calls of $8,100. Buying the 60 calls, as you can see, using the same multipliers costs $3,400 in cash, and in a corresponding way, the 45 puts bring in $4,400, and the 40 puts cost $600 for a total overall net cash inflow of $8,500, which incidentally would require an account of at least $41,500 to trade, which is also the worst case scenario on the trade. Now, an important point to make at this juncture is to reflect on why I emphasized earlier that implied volatility spike that occurred on Twitter options after the Elon Musk news. And so the best way to do that is to look at an almost identical trade, which could have been executed a few months earlier on a day when Twitter was trading at around 35, but this time the implied volatility was down in the 55 area, way lower than the 79 reading it hit right after the Elon Musk news. And so if we take a look at a parallel trade where we sell calls 5 points above Twitter's market price, selling those calls at 40 and buying the 45 calls while simultaneously selling the puts down at 30 and buying the puts at 25, then with 4 days to go, we've essentially executed the exact same iron condor structure as we did before when the stock was trading at 50, and we bracketed the market with calls and puts at the same distance from the stock price as we did here. But if we look at the cash flow here, we can see that this is a completely different story. Each of the options was trading for less than 5 cents because at that point the stock was trading in such a small range, and it would be unlikely that in a 4-day period you get a 5-point move in either direction. And so buying the right to buy the shares at 40, 5 points higher, isn't worth very much because the stock is very unlikely to hit that price in 4 days. And likewise, buying the right to sell your shares at 30, 5 points lower than the stock price, is also not very valuable because a downward move of that magnitude in 4 days is also not likely when the stock is trading within a fairly small range. But when a stock goes on a major tear like Twitter just did after the Musk news, then a move up or down 5 points is much more possible over a 4-day period. And so the options prices will reflect that in a dramatic way compared to lower volatility periods like late February. And so the reward is going to be a lot lower in this case, only $500 compared to the amount you'd be required to have in your account by your broker, which would be $49,500 in this case. And so now let's move back to the trade we could have made last week, expiring on April 8th. And you'll recall that we collected $8,500 for entering that trade. And as you can see on the day that the 4-day April trade expired, Twitter had sold off a bit and finally closed at 46.23. And so now let's get back to the cash flow analysis, because when an option expires, it will be provided with a final value by the Options Clearing Corporation. And so let's start by recalling that we received $8,500 when we first sold this iron condor on April 4th, when the options volatility shot up along with the stock price of Twitter. And you'll see after we account for the $8,500 initial positive cash flow that there's no value left in any of the options. Why? Well, the 55 and 60 calls obviously have no value because no one's going to exercise their right to buy Twitter shares at either 55 or 60 if the stock can be bought in the open market for 46.32. And the 45 and 40 puts have no value because no one's going to jump at the chance to sell their Twitter shares at 45 or 40 when you can sell them for 46.32 in the open market. And so the result is that none of the options have any value, resulting in the final profit coming down to that original cash flow of $8,500, which is in excess of a 20% return on the required capital of $41.5 that we discussed earlier. And so what I'd like you to take away from today's video is the dramatic difference in the trade potential that appears when an options chain's implied volatility has jumped to an extreme right after a big event like the Elon Musk news. When that happens, as you now know, for basically the same trade that we looked at in February, where we only received $500 for the Iron Condor, in the high volatility April period, we received $8,500. That's 17 times the premium, which makes the trade worthwhile and attractive for the potential, which we would have received in this case of a 20% return in less than a week. Professional options traders understand what happens when options volatility blows up like it did in this case, and how that can be leveraged for incredible returns if you understand how to construct option strategies. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it. And please don't forget to hit our subscribe button right now so that you don't miss any of our free training videos to help you to up your game as an options trader.